Hello, and thank you for joining us today. We're going to be going over some options for your cash and savings. We have higher interest rates for the first time in a very long time, so we're getting a lot of questions on, what are some things we could do with emergency savings, extra cash you may have in the bank, and we put together this summary of, what we think are good options, depending on exactly what you're looking for. And then we'll do a comparison of risk and return for each of them. So what we'll look at specifically, just quickly, we'll go into some history here. So we're going to look at, over the past 14 years or so, what the Fed funds rate or short-term rates have been for the past 15 years, and really what's happened in 2022 is when we had the big change. Then we're going to look at the specific, different things that we could utilize this cash for. So first we'll look at Flourish Cash, which is a savings account, and CDs. Most investors and people know, of course, are familiar with these. Then we'll look at short-term Treasury bills, 1 to 3 month Treasury bills. We'll get into high-quality, intermediate term investment-grade corporate bonds. These would be the bonds of Johnson & Johnson, Microsoft, companies like that. And then lastly, we'll look at Traphagen, our own stable value fixed income portfolio, and then what that has to offer. So first, just looking at the history of short-term rates. So this is a chart, again, going back to 2007, 2008, where really from late 2008 through early this year, you just got basically nothing on cash, savings accounts, checking accounts, CDs were 0 to 1.5%. Maybe occasionally for a brief period in 2019, you were able to squeak out a little more, but really for the vast majority of this period, cash, short-term bonds in general just weren't a great option. That has all changed. As you can see, the Fed has aggressively hiked rates in 22, where that red line is. And we have gone from 0 on short-term rates to near 4% and likely going higher, within the next couple weeks here. But right now we stand at 4% on short-term rates. The near-term T-bills, 1 to 3 month T-bills are 4.2%. They're likely going higher. So now, for the first time in more than a decade, we really have a nice selection of options for cash and emergency savings where you actually get a return with little or no risk. So the first one we'll look at is Flourish Cash, which is a savings account. There's no charge for this. We partnered, with a third party on this. This be the pattern for each one of these options. We'll look at, what the best use case, is for this, the risk profile, the return profile, and lastly, the liquidity of the investment. So, this is really for ultra short-term needs or an emergency fund. This is a savings account. That's what savings accounts are for. Just really ultra short-term needs, emergency fund. There is no risk with this investment. It's an FDIC insured savings account, so no principal risk. The yield will go up and down, rise and fall, depending on what the Fed does. So if the Fed continues to hike rates, you will get paid more. If at some point, they will likely decrease rates. That might be 6 months, a year, 2 years out. But if the Fed does decrease rates, then the rate you get on this savings account will go down. That is called rate risk, which there is rate risk here. And that, again, doesn't affect the amount of money you put in. It just affects what you earn on the money, is the rate risk. Your principal is 100% protected and safe with this option. The return, so right now you're getting 3.75% on the savings account, and that is likely to rise to about 4% or even more by mid-December as the Fed is projected to hike rates again in a couple weeks. And on liquidity profile, this is a savings account, so it's completely liquid. You can move funds in and out of this from your checking account within the same business day. So again, risk-free, decent yield, really for emergency savings. The next we'll look at CDs. Fidelity offers certificates of deposit where we have access to from banks, the highest yields available across the country. Obviously, you go to your local bank, get the same. This again is really for short-term financial needs where you do not need liquidity or immediate liquidity, because as almost everybody is aware, CDs, you are locked in for a period of time. That could be a couple months, a year, 2 years, maybe even up to 5 years, where you could get your money out, but if you do, you're going to get a penalty assessed on that. So really, if you're going into a certificate of deposit or a CD, whatever period you're signing up for, a year, 2 years, 3 years, you want not to need that money in that period of time, or else you will get a penalty. And again, on the risk profile, there is no principal risk on these. These are FDIC insured, so no principal risk. And since you're locking in the rate for the period of the CD, for that period you're in there, there is no rate risk either. So you will get that rate for the period of the CD. The negative here is really the liquidity profile, where if you did need the money for something within that period, you would be assessed a penalty or commission on that, and that could range normally anywhere from 3 months interest, maybe up to 6 month interest, usually something like that. So short-term Treasury bills or T-bills, 1 to 3 months in maturity, these have recently become quite attractive, and many clients are utilizing these. So these are again, mostly for emergency funds instead of savings account or pure cash. Ultra short-term financial needs, you could just park it in T-bills. And we like these for some clients. Again, there's no principal risk on these. It's backed by the U.S. government. There's rate risk, where if the Fed, again, if rates go up, you'll make more on these, you'll earn more. If rates go down, you'll make less, or the rate will go down, you earn, but the principal is safe here. Backed by the U.S. government. And right now, with 1 to 3 month, a combination of 1 to 3 month T-bills, you're getting about 4.2%. And that is likely to remain near that level or actually increase somewhat over the next 3 to 6 months. Beyond that, we don't know. But for at least the next 3 to 6 months, you probably get 4.2% or more on this investment. And since we purchase on the liquidity on these, since we purchase not individual bonds, we purchase these in batches in ETFs or exchange traded funds. And those are like mutual funds. So it's a basket of 1 to 3 month treasuries. These are liquid. So there is no holding period. If we if we purchase the ETF of these bonds and you needed the money back for whatever reason in 3 days, 5 days, a week, you could get that money back. There is no penalty. There is no commission. These are completely liquid. And that's one reason why we like purchasing these in an ETF wrapper because of that almost perfect liquidity. We get it out in 2 or 3 days in the form of cash. So this is certainly an option for some clients. Now, the last two are more looking for a little bit more return and a little bit more yield than all the other options. So the first is high quality investment grade corporate bonds. And again, these are the bonds of Microsoft, Johnson & Johnson, Apple, companies like that, high quality corporations. And this would be used for, maybe not your emergency savings, but, if you had, maybe you're looking to buy a house in 1 to 2 years, if you just wanted some amount of money less risky than stocks or something else for a period of time, short to intermediate, maybe 1 or 2 years, this would be a good place to park it. Here, as opposed to all the options that we just discussed, the principal value can go up or down and will go up or down as interest rates go, change through time. Here, though, the rate risk is mitigated. So if rates go down, if longer term, midterm rates go down, the value of whatever you put in will actually go up. So you're compensated for rates going down, and vice versa. If rates long-term rates continue to go up, then the value would go down. So you have to keep that in mind where you're taking on, some volatility. The principal amount, whatever you put in, can go up or down. But if rates go down in the future at some point over the next year and a half or 2, then the value of what you put in will actually go up, and that will help compensate you for the yield going down. Return profile, right now, you're earning about 5.5% on this bundle of bonds. And obviously, that's pretty attractive. These are low risk, not no risk. You can lose money, but low risk. So you're getting 5.5%. And again, over shorter periods of time, you could earn more than that or less than that, depending on what interest rates are doing. And just like the T-bills we talked about before, we purchase these through exchange traded funds or ETFs. So this is completely liquid. If we buy today, we get you cash in 3 days. So again, good option for many clients. And then lastly, our Traphagen stable value fixed income portfolio. is an interesting option. This is, again, similar to the investment grade bonds, good for short, intermediate term financial needs, maybe 1 to 3 years, where you're looking for some, higher cash flow yield, along with maybe even a little bit of growth on top, still with low risk, however, and low volatility. So the principal value will oscillate, just like the investment grade bonds. The principal will go up and down a little bit, although we do design it to be as stable as possible with little correlation to stocks or bonds. Right now, you get about 5% from this portfolio just in cash flow. So no matter what the value does, you're going to get 5% per year just from the cash flow. And then again, over maybe a year, 2 years, 3 years, over the longer term or midterm, the hope is maybe you get 1% on top of that or so in terms of growth. And the liquidity profile here is a little more nuanced, where in some cases it'll be 60% liquid and 40% having limited liquidity in the alternative private investments. Alternatively, we can make this 100% liquid. So that would be, if an investor really wanted to be more on the liquid side and was willing to sacrifice some yield and some potential returns, then we could make this 100% liquid. Normally would go 60% liquid investments, mostly bonds, 40% alternative private investments. But if they really wanted to be purely liquid, we could do that as well. So this is a good option too for many clients. So the last slide is sort of a summary of all the different options we discussed and all the different attributes of each. So I'm not going to go through the entire piece here, but it sort of gives a nice summary of, okay, what's the principal risk? Green obviously means good or low, if you will. In this case, yellow would mean somewhat higher. Rate risk, the same. Cash yield, yellow means lower, green means higher. Liquidity, green means either perfect liquidity or very high liquidity. Yellow means there's some nuance to it in the case of the CDs and the stable value portfolios with some of the alternatives. And then total return potential. Yellow means lower, green would mean higher. So now if you look at this chart, again, it depends on your personal preference, what the time frame you have is, but I would say in general, when you look at this, it sort of points to short-term T-bills, investment-grade corporate bonds, or the stable value portfolio for many clients. But for some, the Flourish cash savings or the CDs, either through Fidelity or your local bank, can make sense as well. But when you look at it like this, I think it's a good summary. And I think it does point to, the 3 on the right. And that basically covers everything I wanted to talk about. Any questions, you could contact myself. My email is on the bottom there, or your Traphagen advisor. And if you do have cash in the bank earning 0, 1, 2%, something like that, it is certainly possible to do much better that in any of these options with either no risk or low risk. So certainly worth talking to me, talking to your Traphagen advisor about that if you do have excess cash just sitting around. Thanks for joining. Hope the best through the holiday season. Thanks. Bye-bye.